Good morning, ladies and gentlemen. Hope you are well on this cold winter's morning. Welcome to our tax chat. And today we've actually had quite a lot of interest in something that is relevant for all of us, and that is tax and energy efficiencies and energy incentives. The new tax legislation that has been drafted, so it's not been finalized yet, and we will have a nice discussion about that for the next hours or so. So without further ado, I'm going to jump into the legislation. But before we start with the new legislation, it's actually just a good idea to just have a bit of an overview of what the existing legislation is. I've broken it down between what is incentives and what would be rebates and what would be punitive legislation. So incentives, so currently we've got Section 12B that is, and SARS have decided not to amend Section 12B to allow for the extra 125%, but to leave Section 12B as it is. So Section 12B provides you with effectively a 50-30-20 tax deduction for renewable energy. But if it was solar power and less than 1 megawatt, then you received 100% tax deduction. So that is still in effect and still applies as normal. There's no changes to Section 12B at all. But obviously now with the implementation of 12BA, it only says that 12BA would have preference over Section 12B for the following 2 years. So that is Section 12B. You have Section 11E. I looked at Interpretation Note 47, and it provides you with the following tax allowances. So solar energy units, you can get a tax deduction over 5 years, for portable generators over 5 years, standby generators over 15 years, battery chargers 5 years. And for more guidance, just have a look at Interpretation Note 47. So those are movable assets used in the conduct of a trade, then you can get Section 11E deductions. Then you have Section 12L, which is a deduction in respect of energy efficiency savings. So that is for years of assessment ending on or before 1 January 2026. And effectively, if you have a SANEDI certificate, then you can get a tax deduction of 95 cents per kilowatt hour of energy efficiency savings. So effectively what happens, the SANEDI certificate will give you a baseline electricity consumption, and then you will invest in certain electricity savings initiatives. So for example, you put in the lights that automatically switch on and off, you put in energy efficiency lights, so all of these kind of things will cost money, and then they will then calculate based on complicated formulas how much savings you've actually generated through this investment that you have, and then you will get a tax deduction of 95 cents per kilowatt hour, and that is a permanent deduction. So for that, you need to look at Interpretation Note number 95. The problem with that is you can't claim it concurrent with other energy efficiency savings initiatives. So it is generally, if you claim 12BA, you can't claim this as well, and it complicates the calculations of this. So if you are now investing quite heavily into solar, that will affect your Section 12L deduction that you have. I'm not a customs duty specialist, but there are preferential treatment for the importation of renewable energy equipment and exemptions. So one should consult with a customs specialist if you were to import renewable energy equipment. So that is your normal income tax. So the new legislation is Section 6C, which I will discuss now in more detail, and that is your solar credit that you receive. And then the newly introduced Section 12BA, both of them are still in draft form. You can still make commentary, and as we'll go through today, you will see that there's actually quite a need for some commentary on it. And that gives you the 125% tax deduction if it's used for commercial purposes between 1 March 2023 and 28 February 2025. Then the punitive legislation you'll find in the Carbon Tax Act. So again, this is a very specialized area, but punitive legislation, so in terms of Section 3 of the Carbon Tax Act, a person is subject to carbon tax if that person conducts an activity in the Republic resulting in greenhouse gas emissions, and then you'll be liable for tax over the threshold. There are, however, incentives within that where there is an offset mechanism. So the carbon tax is becoming an increasingly serious issue, not only for local companies, but for global companies as well. In this week, I met with a client, and it is such an important matter for them globally that they are charged by the global company for carbon emissions in South Africa. So obviously that creates now a bit of a problem, because if you use generators now, you get a charge for that. So from a global perspective, these things are being managed globally, because global, especially listed companies globally, they are measured based on their carbon footprint. And South Africa is now not contributing very well to this footprint, because we are using generators, and we are not really using clean energy. And we'll talk about that going forward. All right, and then you have to look at government grants, and I tried to find out what kind of government grants it would be. So from a tax perspective, Section 12B exempt government grants. Now, the way that it works is that the grant itself is exempt, but to avoid double dipping, you can't get a tax deduction or underlying equipment. So if you receive a government grant and you utilize the government grant in order to fund certain equipment, then you can't get a tax deduction for that equipment. To the extent, so what happens is a limitation. So for example, let's assume you incur R1 million of expenses, and your government grant is, say, 300,000 rand, and you're entitled to a 40/20/20/2012 C deduction on it. So what then happens is your overall deduction in terms of 12B is limited to your cost minus the government grant. So you'll still qualify in year 1 for 40, year 2, 20, put you to 60, and then year 3, you only get 10, because you can't claim more than the R1 million minus the 300,000 rand government grant that you've received. So the most common one that I deal with is the automotive incentive scheme, and they must be very careful that you don't claim more than this. So there's a double dipping, anti-double dipping. The only things that I could see in that list relating to electricity is paragraph 28 and 29. I'm not sure. I've not dealt with these things myself. But if there is a government grant, you've got to check the way that Section 12B works, and you can't. Remember, you can't have your cake and eat it. You limit your tax deductions to the cost minus the government grant. All right. So that is the existing legislation. Let's go through the new legislation. Now, apologies for that. I don't always like taking the legislation and carving up the legislation. I prefer just having a nice chat, especially this is a tax chat. But I think it's warranted now. It's warranted to go into in detail, because we're in the beginning phases, and so many people are going to make use of this. So many people are putting in solar panels, and this is also a deduction that's not limited to people that's conducting a trade. Obviously, there's now split. So Section 6C is now for domestic households. So let's go through Section 6C, and I think it is worthwhile for now to just go into the detail of it. So now, this is a solar energy tax credit. Now, what's the benefit of a tax credit as opposed to a tax deduction? A tax deduction reduces your taxable income, and then you apply your tax rate to that. So if you are a wealthy person and you are at 45% marginal rate, if you get a tax deduction, you benefit from the incentive to the tune of 45%. But if you are at a lower income earning level and your marginal rate is, say, only 30% or 25%, then you only benefit 25%. So this is why National Treasury decided to give you a tax credit. So it treats everybody equal. It doesn't favor the rich. So everybody is treated equally. So I think it's a good thing that they provide a credit as opposed to a tax deduction. All right. Now, the first thing is, so Section 6C deals with your credits. So in determining the normal tax by any natural person. So firstly, you must be a natural person in order to claim this. So a trust doesn't get a tax deduction for this. So it must be a natural person. So the solar energy tax credit applies in respect of cost actually incurred by the natural person. Okay, must be new and unused panels for 275 watt and more, and is brought into use for a narrow period, just the following year. So very importantly, it's the panels only. It excludes installation cost. It excludes the mountings. It excludes the cables. It excludes the batteries. It excludes the inverters. So it's the panels only, which is disappointing because the one can't do without the other. And the reason for this is SARS is saying, well, we don't want to give it on the batteries and inverters, because if you put in batteries and inverters, you're actually using more Eskom electricity, because you're just pulling out the Eskom electricity, and actually at the periods of non load shedding, you're pulling out more electricity in order to charge your battery. So it's not really achieving it. But they could simply have said that it must be an integrated system. We will not allow it. If we just have the batteries and the inverters without the solar panels, you should have at least the solar panels with it. But be it as it may, you can see SARS is always a bit snoop when it comes to tax incentives. I think this is a bit of a nothing. It's not going to have material impact. The people who want to put in solar panels, they're going to put it in any event. There's a 1 year only. And the big downside of this thing is they only give you 25%. They should have given you 100% up to 15,000 Rand so that more people can actually enjoy it. But they only give you 25%. So you've literally got to spend 60,000 Rand in order to get a credit for 15,000 Rand. I also think that it's a bit stupid, because the reality is now you've got to pay the 60,000 Rand and wait until your tax assessment before you get the 15,000 Rand back. Much better situation would have been direct grants to the sellers of solar panels, that the Department of Trade Industry would say, okay, hang on, if you are selling solar panels, I'll provide you a subsidy for an amount per solar panel that you sell. So I think that would be much more preferential, so that people can do it, because now again it's incentivizing people, but only partially. So you still got to have cash. So obviously the banks are now looking at providing loans, soft loans, and home loans, and all those kind of things in order to allow people to do this. But will this really make a difference? You're spending 4,000 Rand on a panel. SARS is effectively paying 1,000 Rand for it. They've first got to fork out the 4,000 Rand, and at a later point you'll get your 15,000 Rand back. People are suffering, so they don't necessarily have that. And then also having a solar panel without a battery, it helps you nothing. So you'll have to put in the battery in any event, because yes, you put a solar panel and you've got some power whilst the sun is shining. That's not really when you need it. You actually need it tonight when the sun is not shining. Anyway, as it is. So now this is quite important. The solar energy tax credit will only be allowed under Section 1 if solar panels are installed and mounted fixed to a resident mainly used for domestic persons by the natural person referred to in subsection 2A. So the person who's incurring the cost, he must, or she must use it mainly for domestic purpose. So if you have a home office, and we'll talk about home offices a bit later, then you're still using the resident mainly, so you can still get your tax credit, but it must be mainly used by the natural person. So when you incur it, so if you have a flat that you rent out, then it's not available to the landlord. What is nice about this is you don't actually have to own the house. So you can rent a house and incur the cost for the solar panels, and then you'll get your credit. So it is available to a tenant. So now what is disappointing is in February, when this was all announced and the National Treasury actually published the frequently asked questions, there it said in that one that it will be available to landlords. And that's now clearly not available to landlords, because the law is therefore not aligned with what National Treasury's instructions are, which is extremely disappointing. It should be available to landlords as well. But we'll talk about landlords just now. And then paragraph 4 says, where more than one person actually incur any cost in respect of acquisition of solar panels, the amount must be apportioned. Okay, so your 15,000 Rand, so if two people are renting a house and or three people are renting a house, and you are splitting the cost in the 15,000, you can't each get 15,000 Rand. Then the 15,000 Rand must be apportioned. So you get 5,000, you get 5,000, you get 5,000. Then the question arises, but what happens if I'm married in community of property? Because if I'm in community of property, then effectively I'm incurring half and my spouse is incurring half. So again, it's not well thought through legislation, because yes, the legislation is there, but the eventualities is not there. And this is the problem with legislation that gets pushed through quite quickly. I don't think this deals with being married in community of property as it should. Okay. Then if you dispose of that panel before 1 March 2025. So you've got a 1-year window period. So it's 23 to 24. And then if you dispose of it thereafter, then that extra deduction that you got would be an extra tax. So I don't know how they're going to know it, but it only applies if you dispose of the panel in isolation. So it's there to avoid people actually almost speculating in it. But I think the effort would have been, because in order to claim it, you've got to show them a certificate, you've got to show them that's been installed and that's into your DB board and all those kind of things. So yeah, so there is a recoupment of this as a tax deduction. But if you sell the house as a whole, you're okay. You don't have to have that. All right. And then it says, so it excludes this. No deduction shall be allowed in this section in respect of any asset in respect to which an allowance has been granted to the taxpayer under 12B or 12BA. So obviously, if the asset is being used in a trade, you can't get the 12BA 125% deduction or 12B 100% deduction or 50, 30, 20, and then claim this credit. All right. So this applies then for a 1-year period. So let's just look at some of the practicalities and uncertainties relating to the Section 6C, rental solutions. So as I stated before, people don't have money. They don't have 60,000 Rand to fork out for just a solar system, and that is before you put in the battery. So for it's very unlikely you're going to get out with a solar solution under 140 to 200,000 Rand. More expensive systems are going up to 500,000 Rand for big houses. But obviously the person who can afford 500,000 Rand he's not doing that in any event. So many people are entering into rental solutions. And the rental solutions is actually quite affordable situation, because literally you can rent a solar solution for 1,500 Rand to 2,500 Rand per month. So people are entering into this. When you do the sums and when you do the financial sums, you're effectively getting to kind of like a 20%, 22% return on investment. That's not really that good from you as a tenant, but it's a good alternative to Eskom, because when you pay Eskom, you're paying Eskom, but you don't necessarily have electricity. So you might as well enter into this affordability deal, even though it's effectively costing you 22%. Obviously, the other downside is you never own these assets. When you sell the house, then the charge is something like a 30,000 Rand deinstallation charge. But be it as it may, is extremely popular now, because people are just saying, well, I'm paying 1,500 Rand and paying 1,500 Rand a month. It's reducing my Eskom electricity. I'm in the money and I've got electricity. So these rental solutions. So the question comes in, if you enter into a rental solution, then are you entitled to this 15,000 Rand deduction? And the problem is that the law is not clear. It talks about the acquisition cost of a solar panel. So what is acquisition cost? What does acquisition mean? Because when you compare the term cost in this context under Section 6C to the cost when you're dealing with Section 11E, when you're dealing with Section 12C, when you're dealing with Section 12B, even when you're dealing with Section 12BA now, the term cost is actually elaborated on. What is cost? Now, in this case, when you've got a rental solution, the rental solution, it doesn't become your property, but you still have a cost. Now, are you acquiring it? I'm acquiring the use of it, but am I acquiring it? So if you look at the VAT Act, for example, the VAT Act talks about a supply of goods or services. So there is a supply of goods to you, but am I then acquiring that goods or services? So SARS would probably challenge you. If you enter into a rental agreement and you want to claim 25%, but you can only claim 25% of the actual cost incurred and only of the solar panels. So the whole solution includes all a host of other things. But again, how is this encouraged? It's probably encouraged through the fact that the lessor of it could get tax deductions on it, and then you can't get a Section 6C deduction. But it's a bit sloppy work, I must say. Sloppy work by just talking about acquisition cost. It should be described in more detail. So just an observation, when the legislator goes around and tries to push something through quickly, they should still go into the detail and say, you can't just talk about acquisition cost. It should be very, very specific. All right, so I would be hesitant to claiming that 6-year allowance if I just enter into a rental solution. It's unfortunate that you don't provide a benefit for the person entering into that rental solution, which is extremely important. unfortunate. All right. And then in the frequently asked questions issued by National Treasury, the issue of body corporates have been addressed. Now, body corporates is a special entity for purposes. It's treated differently for income tax purposes as well as for VAT purposes. But for income tax purposes, body corporate is not necessarily an exempt organization. What is exempt from body corporate is the levies that it charges. And there's a whole interpretation out on body corporates. But Section 10(1)(e) exempts levies received by the body corporate. So there's a lot of uncertainty about what is a levy and what is not a levy. Many body corporates are buying bulk water and then selling water to the households. And the question comes in, when I buy the bulk water, I'm selling the households. If I make a profit on it, when I'm selling that water, is that a levy? And there's both routes to the argument. In many instances, the body corporate is then buying bulk electricity from Eskom and then on-selling it. And the question is, if they make a margin on it, is it taxable? Is it not taxable? Is it a levy? Or is it the supply of actually service? And then, because if it's now electricity that you are buying and selling, it's almost a trade that the body corporate is now entering into, and that can be taxable. And the same with the water. So there's uncertainties about it. Generally, you can plan yourself out of it better, so that even though it could be regarded taxable, you can still plan yourself that the tax incidence is zero. So you just got to contractually see that you are recovering the cost and even the future cost that you get a tax deduction on a 24C. That's the story for a different time. For now, body corporates, and especially large estates, it makes sense that a large estate will actually build its own solar farm or wind farm for that matter, and then incur the costs for a solar farm, and then effectively recover that cost either through a levy or through a direct charge. It could be through a levy because it could be seen as communal property. So the body corporate can go and say, listen, guys, I'm going to build a solar farm, communal property, and then, but what will happen? We will increase everybody's levies by 20%. Then it's an exempt activity. So in the frequently asked questions in National Treasury, it says, if occupants are unable to install their own panels, then the tax incentive applies as for all individuals. So each household installs a solar panel. Okay, you can get your 6C deduction. A body corporate will not be able to claim this incentive. It is not clear whether many body corporates will be purchasing solar installations instead of using leasing with other options to avoid upfront costs for members. So government will be consulting on this aspect. Now, I've not seen anything in this regard. If there's widespread interest in body corporates purchasing and installing solar panels, then payment for solar installations levied for would have to indicate the cost of the solar panels separately, as would be the case for any other claimant. So this is a difficult one, but I'm not seeing anything on this, because if the body corporate incurs it, it's not a natural person, so they can't get the 6C deduction. Again, it's unfortunate, so we've got to work around it. But this is lost opportunities. It seems that you've got a disconnect between the strategic objectives of actually increasing the power generation capabilities in the country, and then the tax man trying to collect as much as possible tax. But as a matter of fact, and the CATS Commission came out on that years ago, many commissions have come out, they said, you know what, tax incentives is not a great tool in order to incentivize activities. Direct incentives is much better. So I'm not always in favor of tax incentives, because I've done this for 30 years. I've seen very little change in behavior because of a tax incentives. Take the R&D. I've seen, this has been with us for ages. It's like a sweetener on top. People who want to do R&Ds, they're going to do it in any event, not because of the incentive that you're going to get, but nobody has moved. Well, nobody that I know about has moved the R&D activities to South Africa because we've got the R&D incentives. It's just, there's other reasons for not doing that. And the same thing for this. So are you really changing the behavior, or are you just kind of like saying, you know, guys, we're just sweetening it with, I would much rather have seen, because the solar panels, firstly, there's a supply problem. Secondly, there is a cost problem. Thirdly, the rand is affecting the cost of imported solar panels. So you've seen a doubling in the price of solar panels. rather give a direct incentive so that you can subsidize the price of the panels. That will have a direct impact on everybody. So for me, this thing doesn't make sense. So that is Section 6C. Frankly, worthless piece of legislation, in my opinion, not going to make any dramatic impact. It would be a sweetener for some people, but to make a dramatic impact, it's not going to affect the person who on such a grand scale that it's going to make a difference to South Africa. It is there just to appease the population that, yes, the government is doing something about this problem. Not really. So let's get to Section 12B. Now, this is the one that everybody is so interested in, and many businesses are extremely interested on that. So I will elaborate quite in detail on this one. So let's go to it, because as I said previously, we all thought as the legislation came out that they're just going to expand 12BA and make 12BA as it is and just an extension to 12BA. And funnily enough, they didn't go that route. They introduced a whole new section. They introduced Section 12BA. Now, as you'll see later, this, I think, was a mistake on their part, because now there are auxiliary legislation that also need to be changed, where if you just added it in 12BA as a subparagraph, Bob would have been your uncle, but Bob is now not your uncle. All right. So again, it is all about the date that it's been brought into use. So it's not the date of incurral or anything. But what is important here is that the assets must be owned by the taxpayer. Okay. So it says, in respect of any new and unused machinery, plant, implement, utensil, or article. Now, firstly, look at that. Unused machinery, plant, implement, utensil, or article. And I'll talk about that just now. Owned by the taxpayer's purchases in terms of an agreement, so it's a purchase, or in terms of paragraph A of the definition of installment credit agreement. Now, paragraph A of the definition of installment credit agreement is simple. In terms of that, it is an agreement of sale, but all that happens is that you pay an amount, the VAT is payable up front, but ownership only passes at the end of the period. So ownership is retained by the lessor in terms of a paragraph A1, but ownership passes when you pay the final installment. Ownership passes. So for tax purposes, generally for 11E purposes, 12C purposes, all of those purposes, it's deemed actually to be the property of the person. This is exactly the same as what you found at 12C, 12B, and the like. So there's nothing funny about this one. Okay. So it is brought into use for the tax-based trade 2-year window period, 1 March 2023 to 1 March 2025. Okay. But for the purpose of trade, so let's look at what does the definition of trade says. Trade includes any profession, trade, business, employment. It includes employment. But now remember, and I'll deal with that just now, once you get into employment, then you have to deal with Section 23M. And 23M then says, if you're in employment, you don't earn commission on all those kind of things, you only get 11E deduction. So even though it's in the trade, if you're in employment, by default, if you earn a salary, you're not going to get the 12BA. So if you're in employment, you're not going to get the 12BA deduction. If you use a house that is more than 50% used for business purposes, you are, and you're not going to get the 6C deduction either. So if employment, so you've got to be very, very careful about that one. All right. So it's wind power, solar energy, hydropower, biomass power. So it's the same. So they just regurgitated that one. All right. And now it's interesting there. They talk now about the foundations. And this is now where you see the sloppy drafting work, because now they start talking about provided that where any machinery, plant, implement, utensil, article, or improvement. So somebody has just literally copied and pasted a section on foundations that you find in Section 12C and 12B into 12BA. Now they're talking about improvement. Yeah, there's nothing talking about improvement. So you're talking about 12BA, where the term improvement is not there. You don't get it on an improvement, but you get the foundational improvement. So just sloppy drafting work. And that is frustrating because it should not be. All right. So essentially, but if there is a foundation linked to it, then the foundation is deemed then to form part of the asset itself, provided that the life of that foundation is also limited to the life of the asset itself. Now that becomes relevant, for example, something like a wind farm. Now, wind farm is a massive structure. It's a steel structure, but there is a foundation that's underneath the ground, which is effectively a permanent structure. Now that foundation is deemed now to be part of the wind turbine itself. All right. So sloppy draftsmanship. All right. So the deduction is equal to 125% of the cost incurred by the taxpayer for the acquisition of the asset. Now, this is where you should take some care, because when you do your tax calculation, you do your normal tax and your deferred tax calculation. And as you'll see, our next tax chat will be on normal tax and deferred tax. So that's going to be a nice, interesting one. You deduct the 25% as a permanent difference, top of the line, and then you deduct 100% as a temporary difference. And then for accounting purposes, you add the depreciation as and when you'll be depreciating it. So there will be a deferred tax asset, actually deferred tax liability created, because your tax value would be zero and your accounting value would be something different. Now you can include the direct cost of installation or erection of this into your cost. So 12BA, but it's a regurgitation of 12B. For a large extent, it's a regurgitation. Now this is where it becomes interesting here, because it says here, no deductions shall be allowed. Remember, I talked about the rental agreements, okay? Where the rental solutions is. Now the question comes in, if I'm the supplier of these rental solutions, so on a large scale, I will go out and I will put solar panels, batteries, all of those kind of things into people's houses. And I do that in grand scale, and you rent that solution from me for 1,500, 2,000 Rand a month. Okay, then that person's now got to look at this section. It says no deduction shall be allowed under this section in respect of any asset which has been let by the taxpayer under a lease. Okay, so first he said you don't get it if it's a lease, other than an operating lease, and then there's an exclusionary lease, unless the lessee derives income from it, and the period is at least 5 years, or if it's, but in solar assets, it would be at least 5 years. Okay, I'll get to that just now, but it's what is interesting here is that when you look at section 12B, section 23 cap A links and limits the deductions of 12B to taxable income from rental activities, from leasing activities. The only thing is excluded is an operating lease. So there's a link to 23A, but 23A is not amended, and I've not seen that 23A is amended. So 23A normally says, yes, you can lease it, you get your tax deductions, but you limit your tax deductions, your taxable income from rental income, to whatever portion you don't get, okay, gets carried forward to future years. So it's not as if you lose it; it just gets carried forward. So if you rent out leased assets and it's subject to 23A, then your taxable income is zero, but you will have unutilized capital allowances, almost similar to a mine like section 36, that carries forward to future years. But strangely enough, 23A has not been amended, and that's why I say if they have just added another section, subparagraph to section 12B, then 23A would have automatically applied to this. It seems that they forgot that 23A could apply to this as well. But remember, it's now under an operating lease agreement. All right. And this paragraph B and C is just to make sure that you don't double claim. So this is, you can't claim under 12B and BA. And if you're a seller in installment credit agreement, the buyer gets a tax deduction, not the seller. All right. Now, this is a recoupment provision. It says that if you sell that asset before 1 March 2026, then you recoup an extra 25% of the cost of that asset as a recoupment. Okay. In terms of section 84A. Now, if you look at the whole thing now, if you look at the deterioration of the rand, if you look at the increase in demand, you've actually seen an upward curve. So it could be that somebody will buy an installation for 100,000 Rand, get a tax deduction of 125,000 Rand, actually sells it for 125,000 Rand. So let's assume that happens. What happens then is section 84A kicks in, and you have your normal recoupment of what? Not 100,000, of 125,000 Rand. The extra 25% is not excluded from 84A because now it's recouped. And then this deeming recoupment comes in, and it kicks in another 25,000 Rand. So you could have a situation that if you buy an asset for 100,000 Rand, you get 125,000 Rand tax deduction. Before the 1st of March 2026, you sell it for 125,000 Rand, and you'll have 150,000 Rand taxable income. Unlikely to happen. It's anti-avoidance legislation. unlikely that you will incur all this cost and then sell it before the 1st of March 2026. But you have to be careful, because if you sell your business as a going concern, this may actually trigger it. Because this is not, there's no exclusion to this. It says where before 1 March 2026, a taxpayer disposes of an asset contemplating subsection 1, there shall be included in taxpayer's income 25% of the cost of that asset. So it could inadvertently trigger you, because remember, if you sell your business as a going concern, then you're not selling a single asset, you're selling all your assets, and you've got to attribute a value to each underlying asset. Go and look at Interpretation Note 94, what it talks about when you are selling a business as a going concern. So now I'm incurring a bucket load of money on Section 12BI assets. I'm very happy I'm getting my 125% deduction. Buyer comes along and says, hey, I want to buy a business. And you say, okay, great, I'm going to sell my business. Then you attribute your sales prices. You've got to remember this extra deeming recoupment, which is madness. You should not be having this redeeming recoupment if you sell the business as a going concern to a party. So be very, very careful of that, because all sale of business agreements happening before 1 March 2026, if you're doing a due diligence, if you're considering that, have a trigger point there and say, but hang on, I may have this extra 25% recoupment that I may not otherwise have thought about. All right. So let's look at 12BA in summary. So I've tried to dumb it down a bit, and I like mind maps. So the first question is the asset owned by the taxpayer? And that includes paragraph A of the definition of installment credit agreement in the VAT Act. Okay. So if the answer is no, then you do not get a Section 12BA allowance. Obviously, the mere fact that you don't get 12BA doesn't mean you don't get anything else. Then you go, okay, I'm renting it, so I can get 11A deduction. I am, I can get 11E deduction, anything like that. So I'm not dealing with that one. But 12BA is not applicable. You've got to own it. So if you own it, then you ask yourself a question: is the asset used by the taxpayer in the trade and brought into use in this window period of 2 years? If the answer is no, sorry, you don't get any 12BA deduction. Then you say, yes, I'm using it in the course of a trade. Then you say, is my trade that of where I lease an asset to a third party? If the answer is no, then Section 12BA should be available. I'm saying should be because, there's all other kinds of factors that you're also going to include. If the answer is yes, I am leasing it to a third party, you're not finished. Then you say, is the lease an operating lease as defined in Section 23A1? So that means it's like an Avis rent a car. Which is unlikely on solar assets. I mean, you're not going to have a solar asset and lease it for periods less than 1 month for different people. So that's not going to happen. So it's unlikely. But if the answer is yes, that it is an operating lease, then Section 12BA should be available. All right. If the answer is no, you're not finished yet, then you say, does the lessee under such lease derives in the carrying on of his or her trade amounts constituting income for the purpose of this act? This is a critical one. This is a critical one because I now rent assets. I'm the renter. Now my availability of 12BA is dependent on the tax position of the lessee. If the lessee does not derive income from the carrying on of a trade, now remember, employment income is a carrying on of a trade. So I've now got to inquire, does the lessee to whom I'm renting this asset get income from the carrying of trade? If the answer is no, then I don't get 12BA. So if I'm renting it to a public benefit organization that's not trading, I'm renting it to a school, I'm renting it to a pensioner, I'm renting it to a student, I don't get a tax deduction because they're not conducting a trade, which is absolutely ridiculous. So I'm not getting a 12BA deduction. If the answer is yes, then you're not finished yet. Is the period 5 years or such reduced period as what the assets would last? Okay. If the answer is no, so I'm renting it on a year-to-year basis, this year-to-year basis, you don't get it. If I rent it for 5-year basis, then I do get it. All right. If the answer is yes, then I get a 12BA deduction. So can you see? So what is the government incentives? The incentive is to say we want to kickstart power generation. But how difficult are they making it? one of the ways to kickstart it is to actually encourage the business where people are grand scale. It's not only reducing the effort on Eskom on a grand scale. It is creating jobs. It's creating a lot of things for people that can install now the solar and then renting it out on favorable terms to people. But look how difficult they are making it. All right. So let's look at, as I said, when you compare 12B to 12BA, all practical instances the same thing. You know, the same requirements on letting, the same requirements on ownership, the same requirements on foundations, but it's just drafting error because the foundation talks about improvements, but you don't get it on improvements. You only get it on the articles themselves. Okay, so bit of a drafting mistake there. Hopefully they're going to fix it because hopefully people are going to comment on this. All right, now let's talk about practicalities on Section 12BA. First thing is, what assets would qualify? Now, when you look at it, it just talks about machinery, plant, implement, utensil, article to be used by the taxpayer in the generation of electricity. Right. So it's a bit of a wide term, but it's a qualified term. The term is qualified by saying in the generation of electricity. So if you go to binding class ruling 085, which actually deals with income and deed partnerships and Section 12B, but the terminology is the same, they specifically include a whole list of things. They include the solar panels, the solar cells, the inverters, the power optimizers, the controllers, the cabling, the foundations, and the installation costs. Okay, so they're including all of those kind of things. But you can't just take it because of the nature. You have to go, especially if you're doing this on the grand scale, you have to go and say, where does the process start and where does it finish? Where does the process of electricity generation start and where does it finish? So let's look at the wind farm. The wind farm, you've got your wind turbines. Okay, so clearly there, the turbines turns and they're already there, the electricity starts. No problem. The wind turbine, everything with the foundations, all of those kind of things qualify for 12BA. Then you've got a transformer. The transformer changes low voltage to high voltage, and then you've got substations. Again, it's got switchgear and everything changing low voltage to high voltage. Now I've got electricity, and then what am I doing? Then I've got cables that put it into the grid. Now, the problem is I've got to own the assets. Now, firstly, if there is a substation building that's around it, could you say that that substation building is owned by me? I can't claim it under 12BA. Section 13.1 is a process of manufacture. Process of manufacturing electricity would qualify, so I can get a 13.1 deduction, even on leasehold improvement buildings. But I've got to be careful about those things. Because if the building is, for example, just an admin building, and it's on a farmer's land, I don't get the tax deduction. But now, after this 0.3 in this illustration, you've not generated electricity. All that you're doing now is transporting the electricity to the Eskom grid. If you incur the cost of the cabling from that point onwards, there's a risk that even though it falls under cabling, that point there is after the process of generating electricity has been completed. Then you've got to look at 12D, which gives you a 20-year period. So you've got a risk that once you've produced, you've got a solar farm, you've got a wind farm, and once you've produced electricity, your last, like there at the substation where you're changing, from that point onwards, you're just transferring electricity. Obviously, there are contrary views because even transferring it across the power lines, you're actually dropping your voltage constantly. But if your intention is just to transport it for 10 kilometers into the Eskom grid, you could be at risk that the process of manufacture stops at an earlier point. So you've got to look at this quite carefully. And the same thing applies for solar farms. Solar farms just got different things, and when you look at all of that, but as you're advising people, or perhaps yourself as an independent power producer, think about the different elements and don't just assume. You've got to go back to the law, got to go back to each element in it and going to say, do I get 13.1? Do I get 13 Quin? Do I get 12BA? What do I get? All right. And then very importantly, if you're in a big project, what about your foreign exchange? Now, foreign exchange is governed by Section 24I, but this is quite important because now with the volatility in the rand, it's affecting the issue. So you would have a foreign exchange date on which you would order it. Okay, then you order it, and then you've got a foreign exchange date on which date you receive the goods, and then you receive an invoice, but later, and then after the invoice, you would receive, you would then make payment. So your asset is capitalized on the date that you unconditionally, it's a spot rate on the date that you are unconditionally obligated to pay that amount, which would generally be the date on which you will assume risk and obligations, which is the GRN date, the goods received no date. Okay. Then when you pay it, that difference is generally deductible under Section 24I. The problem is, remember Section 24I7. 24I7 says that if you are incurring Forex gains or losses, and it relates to any construction of any machinery, plant, implements, all those things, so solar farm would apply. Then what happens is you delay the incidence of that Forex gain or loss until the date that you bring the plant into use. So if you're building a solar farm with 50, solar farm with, say, a wind farm with 50 units, that's going to take you 2-3 years to build. Okay, so the Forex can only be taken into account at the time that you're actually bringing it into use. So be careful about the foreign exchange. I've talked about what if you sell it, and I said be careful about that extra recoupment. The 84A applies also to the extra 25%. So don't think that your costs, you've got to keep track of this. And what's going to happen is people are going to lose track on it. They're going to lose track of it, especially if they make more than the original cost of it. Okay, and remember that first one before 1 March 2026, on all sales of businesses before 1 March 2026 as a standard due diligence procedure, you've got to say, did we claim 11BA? Sorry, 12BA? If I did, I've got an extra 25% that's going to hit me. Okay, on the cost. So that is something that should be addressed. We talked about the rental side, and here I just allude to the absurdities of it. So I've got into a rental agreements. So I've now got to look at the nature of my tenant. So if the lessee is a pensioner, a student, an unemployed person, then the lessor can't claim a tax deduction. If the lessee is even an exempt institution like the state, the public benefit organization, a university, a school, a church, the CSR, Arms Corps, amateur sporting body, then you can't get a 12BA deduction. That's absurd. Even if it's a body corporate, it becomes, now you've got to ask the body corporate. So you go to a major estate. You say to the estate, listen, I'll implement the solar farm and I'm going to rent it to you. Okay. And if the estate then recovers it through an electricity charge, then the estate will be taxable on the electricity charge. They'll be conducting a trade. Then I can get the 12BA deduction. If the estate is going to recover it through levies, then I can't get a tax deduction. How ridiculous is this? So the complexities of this now makes life almost unbearable for all of us. All right. So don't assume. And then Section 23A, I don't know whether they're going to change it or not. Obviously, this is just draft legislation. I think I don't know whether it's an oversight because I don't know what you want to encourage. So what are people doing? For me, when you're looking at something that's really going to kickstart, and this, believe me, this is a crisis similar to the crisis we had with COVID. It's losing jobs. It's costing the economy. It is deteriorating the rand. It is creating damage. And yes, we are not following how many lives it's costing like we did on COVID, but it is just as serious. I would like government to treat it just as serious. This is not enough. 2 years. I mean, if you're looking at a big project, and this is what we want the major global companies to come in, renewable energy companies coming in and just putting in solar farms, putting in wind farms, and putting in renewable energy projects, because and then saying to them, okay, hang on, we've got special incentives for you, we've got tax holidays for you, we've got that. You're making it so difficult for them because they want to come in here. Then they have to have all of these requirements that the percentage of net income before tax must be spent on social development, etc. We need electricity and we need it now, and we need it seriously. Too little, too late. This is, in my opinion, just not really going to work. But people are innovative. So there's this thing that I came to deal with, and that I did some research on, and one of my clients are currently looking at it now. And it's what you call virtual energy wheeling. And it's interesting one, because if you go and search on the Cape Town municipality website, you'll find that they actually starting to implement some pilot virtual energy wheeling projects. So what is all of this? The problem statement comes in: Eskom needs additional power generation capacity, but they don't have resources to build it. Even the ones that they are building, it's not operational. So Eskom requires that, because Eskom runs the grid. They want people to put in electricity into the grid. So that is a need. Independent power producers, they can do it. There is technology that that they can supply power to the grid, and they can supply renewable energy into the grid. We've got enough sunlight, and especially at the coast, we've got enough wind. And then with that, major companies are facing increasing carbon tax liabilities and also global carbon tax liabilities. So what's a solution that people are looking at? And it's essentially, at the center of it is a large company. It's a company that's got money, a company that's a big consumer of electricity, but that does not necessarily have a big plant, because if you are a company and the problem with solar is you need space. So yes, you can have a solution where you can put solar panels on your roof, but if you don't have space, you don't have space. So if you are a major retailer, and you operate in a variety of shopping centers, you don't have space. You don't even own the building. You rent the building. But now you're paying bucket load of monies on generators. If you're part of the global company, you're getting hit by carbon credits and the like. So you're kind of like snookered. So what do? The consumer enters into a tripartite agreement, and the tripartite agreement is between the independent power producer, Eskom, and the consumer. So what happens is the consumer enters into a long-term arrangement with the IPP. Says to the IPP, okay, I'm going to buy virtual energy from you. Now, it may be a major retailer that's across the country. So you don't actually buy the power that you're going to utilize. It's not that there's a specific line that runs to you. You buy virtual power. So you say, okay, I'm going to buy so much kilowatt hours from you. Boom. And I'm going to do it for the next 5 years, 10 years, 20 years. Okay. So let's assume you enter into a 20-year contract with the IPP. The IPP now has got this contract. This contract is worth something. It is worth money, because it means that the IPP is going to earn annuity income over the next 20 years. The IPP takes that contract and it goes to investors. It goes to the banks, it goes to investors, it goes to preference shareholders, it goes to global investors. It said, guys, here I've got a big company in South Africa that has got money. It's an A-class, and they're going to pay me X. They're going to buy from me so much electricity over the next 20 years. Okay. So armed with that, they then go and they beg and borrow money, and they build a solar plant. They build or they expand the capacity of it. Okay. The independent power producer, they still provide the capability into Eskom. What Eskom then does is now you've got the municipality coming into play. Now, the municipality is not part of this tripartite agreement to start off with, but the municipality has got an arrangement with the consumer. You still pay electricity to your municipality. So if you have multiple places, you still pay electricity to Ekurhuleni and Cape Town and Joburg and to Uppington and the like. So you still pay your electricity as you like. Okay. The municipality sells electricity to you, and the municipality pays electricity to Eskom. So Eskom then goes and says, provided, and this is the big proviso, provided that the municipality is a performing municipality, so they're actually paying me for this, I'll give you a credit. So in a perfect world, what happens is, if you're going to pay 100 to the independent power producer will sell the electricity to Eskom. Eskom, because they save money, because they don't have to build a power plant, they will give you a credit. So in a perfect world, you're doing this as an investment. As a consumer, as a company, you says, I'm going to pay 100 to the IPP, but I'm going to get 120 back from Eskom. You do this as an investment opportunity. But also importantly, especially global companies are sitting and saying, I'm getting carbon credits for this. Because now what's happening is, even though I'm buying my electricity from the municipality, I can actually say I'm buying my electricity from the IPP, which is a green one. So for global companies, especially that needs carbon credits, this is something that could be explored and see what actually it does mean for us. The downside of this thing is your rebate from Eskom is dependent on something that you don't have any control over. It is whether or not the municipality from which you buy is actually paying Eskom. Now, apparently you can chop and change it, but you can only chop and change it up to a level. So if you are overly invested in Ekurhuleni, for example, if Ekurhuleni defaults, then you're not going to get your money back. But something to consider, but it shows you how innovative people can be in order to overcome problems. Okay. So let's look about working from home. I quickly alluded to that. Now, Section 23M deals with employment income. And essentially, it says to you, when it comes to capital allowances, unless you are a commission earner, okay, so you just earn a remuneration income, you can get 11E deduction. So if you as an employee buy a computer, you can claim 11E deduction. But if you're an employee, incur cell phone costs, you can't get a tax deduction for the cell phone cost because you can't get 11A deduction. So you can't get 11A deduction. You can only get 11E deduction. By implication, because it limits to what you can get. So it says you can only get it. So the only capital allowance you can get as an employee is 11E. You can't get 12BA. Okay. So you can't get 12BA. If you look at it, there's been a lot of hoodoo, obviously, of during COVID, after COVID. Most people have moved back again, and are working predominantly now from office again. And you have to look at the interpretation note that deals with home office expenses. But as you go through it, you just get the feeling that SARS is very hesitant to allow deductions. And if you're claiming a home office deduction, they just hit you. So, and then they talk about electricity generation in there. And frankly, they talk a bit of nonsense there as well. So they do allow you 11E deductions, but they say you can't get 12B because it's excluded, correctly so. Okay, but go and have a look at what they are saying. And but funnily enough, here they are almost alluding to it that your solar solutions could be integrated in the home and then become an asset of a permanent nature, that it almost affixes to the property. So it's almost the law of ascension. They say, no, but it's now part of the immovable property, that battery that. Now, I think it's a bit of a nonsense, because if I look at my batteries, it's like loose. I can just unscrew it and I can take it with me. After 5 years or whatever, I'll have to replace it. The inverters, I can replace it. For me, it's still movable assets. So you look at different factors. One is the way in which it's affected. Can you remove it without destroying it? Yes, you can. What's your intention? Is your intention that becomes part of the building? No, my intention is that it still be loose. If I want to, I can take it out and take it with me to my next house. Okay, or I can sell it with the existing house. Obviously, I'll have to specify it or not. So the intention is very, very important. So anyway, so have a look at that one. Then you say, okay, so people are saying, oh, hang on, what kind of solutions do we have? I have a lot of clients that comes to me and say, what the hell must I do? What must I do? I'm forcing the people to work from home. Many of my clients have actually just canned their office rentals. And they're saying, listen, this thing is working. Everybody's working from home. But as the company, I'm happy to put in a battery and inverter for them so that they can actually work, because I can't afford them for 4 hours per day not to be online. What must I do? They must work from home. So the company is paying they buy the battery, they buy the inverter, even they're buying the solar, installing it in the house, and then say to the guys, you can use it. Then you've got to look at what the 7th schedule to the access. The 7th schedule to the access, if you provide the right of use of that asset, that is mainly for private or domestic purposes. So now this becomes difficult. Your intention may be that it's for business purposes, but it could be. So if it is, your private use can only be incidental. So private uses must be incidental. So you can't put in a battery system into a house and the private use is incidental. It's not even mainly, it's just incidental. What's incidental? It's every now and again. But your private use is every day is going to work from batteries. So you can't really argue that one. Then you say, okay, the normal rule is if I provide you with the use of an asset, I tax you 15% per annum on the cost of the asset. So that's a solution. I'll buy a solar solution for 100,000 Rand. I'll tax you on 15,000 Rand per month. Sorry, per year. That's kind of like a bargain. I put in 100,000 Rand, I get a tax deduction actually of 125,000 Rand, give you the right of use of the asset, and I tax you on 15,000 Rand per year. That's kind of like a good one. But then you've got to check, there's a requirement. If the right of use is provided to the employee for the for effectively the effective use of that asset, you've actually got to tax him on the cost of it immediately. So you can still incur then 100,000, get 125,000 Rand tax deduction, give it to the employee, say, you can use it for purposes of the trade. I'll tax you then on 100,000 Rand because that's then the cost. You're still in the money with 25,000 Rand, all right? But it's becoming less beneficial, obviously. So the only exclusion, if you were to put company assets into a house, batteries, inverters, solar panels, whatever, and you allow your employee the use of it, the only way you can escape the 7th schedule is if the private use is incidental. It's incidental. So every situation can be dealt with. So if you put in a battery solution that is just sufficient enough to carry his Wi-Fi, to carry his essentials and all those kind of things, and you say to him, listen, then maybe you can get away with it. But what's a good solution? So this one, I'm not saying it is a solution that will work, but it's a solution that you could consider. So let's think about this solution. The employer, so let's think about the rationale of it. Employees are sitting there and saying, guys, I need electricity. I don't have electricity. I want to buy it from Eskom. I can't buy it from Eskom. Eskom is not providing it to me. I need something. The employer says, hang on, my employees must be available any time of work. Some of them are working at home. But even so, I'm quite happy. I am going to invest in the welfare of my employees. So I am going to buy solar solutions. I'm keeping the ownership of it. So I'll put in a solar panel. I'll put in the inverters. I'll put in the batteries. I pay for it. Okay. I don't allow but I don't want to just give it to the employees. I also don't want to rent it to them. I will sell electricity to them. So I'm getting out of the use of assets free of use to your relationship with the employee becomes that of a power purchasing agreement. They're buying electricity from you. They're not renting the equipment from you. They're buying electricity from you. And if you look at it, you can actually quite exactly see how much electricity the solar is putting into your system. So every month you go and you say, okay, I've put into your house, I've put in so many kilowatt hours. I'm charging you exactly what Eskom would have charged you. Okay. But you're now buying electricity from me. The employee is happy because at least you've got electricity. You're happy, you're getting 125% tax deduction. You get taxed on the income from the employee. That's fine. But you can tax on, and you've got a happy and contented workforce and he's got electricity. I don't have a rental. I don't have the use of an asset by the employee. It's still my asset. I'm selling electricity to him. All right. Theoretically, you can get 125% tax deduction on it now, but don't take it my word on it. It's something that one could consider, and it could be something that SARS will crack down on very, very quickly because it should be easy to do. All right. The last thing I want to talk about today, and apologies, we're going slightly over time, is the in-commodity partnerships. So this is investment opportunities that people came up from, and that's where the binding clause ruling 085 came in. So how does this work? I'll just illustrate to you the way that it works. Firstly, okay, hang on, sorry, before I go there, I think it is important. So obviously these slides will be distributed by Natasha, so please have a look at this. Remember this, it's an extract from the court case of the Chipkin court case. So whenever you need to deal with the tax consequences of a partnership, go and look at the Chipkin court case because it tells you what a partnership is. It says the Act does not recognize a partnership. You'll be amazed how many times I've seen legal agreement which says, I hereby sell my partnership interest to you. You can't do that. You can't sell a partnership interest. Okay? You sell a share in each underlying asset. You're selling 20% of a vehicle, 20% of a plant, 20% of a debtor, 20% of this. That's what you're selling. So, okay, so the Act does not recognize a partnership. It recognizes only income that accrues to partners in common, which is attributed to them proportionally, and it similarly attributes to the individual partners deductions and allowances that are granted by the Act, with the resultant taxable income of the partners individually. So if I sell my partnership income, and that partnership has got a manufacturing entity, I would recoup a part of my 12C deductions. Same way I'll recoup my 12BA, I'll recoup my 12B. All right. So how does these in-commodity partnerships work? So in-commodity partnership, firstly, is a very special type of partnership. It's a partnership where, as a partner, normally I am unlimited liability in the partnership. But in-commodity partnership is I am limited to the risk that I take towards the external party. So that is a contractual risk. So normally it is my contribution to the partnership. So I'll take $1 million, and that will be my contribution to the partnership. It's R1 million. My liability towards third parties is limited to R1 million. Okay. What the Act then says, it says that in-commodity partnerships, and it's dealt with specifically in 24H. So you look at that, it talks about a limited partner. That's an in-commodity partnership. My tax deductions is limited to my commercial risk that I take. Because what used to happen, people used to invest in plantation partnerships and aircraft partnerships, and they got accelerated allowances through this. Then they got accelerated allowances. Now, what they're doing is they're creating in-commodity partnerships. In-commodity partnerships is then investing in solar farms, in wind farms, and all of those kind of things. And then those partnership is actually entering into power purchasing agreements. Now, remember, this is not a rental agreement. It's not a lease agreement, because otherwise 23 Cap A will kick in. It's a power purchasing agreement. They're saying, I'm selling kilowatt hours to you. So they're doing that with households. They're doing that to factories. They're doing that to whatever. Now, the ruling under BCR 0085 says that the investor, as you are investing, you can get a 12B deduction. So if I'm investing R1 million, I can get R1 million tax deduction if it's below 1 megawatt. Okay. If I'm investing it's over 1 megawatt, I can get a 50-30-20 deduction. That is what it says, because as an investor in a commodity partnership, I can get a tax deduction. Now the question comes in, how will 12BA impact these in commodity partnerships? So can I, as an investor, now claim 125% deduction? And the answer is no, not now, because your deduction under section 24H is limited to the commercial risk that I take. So even though as an commodity partner, I can put in $1 million into an commodity partnership, even though it put a 12BA adjustment, I'm entitled to 1250 tax deduction in 12BA. 24H override this thing and then says your deduction is limited to commercial risk that you take. The unutilized portion is carried forward to next year. So don't assume that if you've invested in the in-commodity partnerships that you can now continue with that and get a 125% tax deduction on them. But go and have a look at that one. All right. So the big risk on these things, people have approached me, and I've helped them in evaluating whether or not they should be investing in in-commodity partnerships. I think it's a good thing. I think it's a very viable solution by pooling resources, because again, as a country, what do we need to do? We need to pool resources, pool money together, and create power generation capabilities in the country. That's the only way we're gonna survive this. All right, but the in-commodity partnership, you can't get that extra one because your commercial risk is limited to the R1 million that you have. So I want to thank you for attending this webinar. For me, it was a lot of fun actually preparing for it. I actually learned quite a lot of new things as I was preparing for it. I do think we need to submit commentary on the draft legislation. I hope SARS will fix some of the problems and create some clarity. I really hope that as a country we can get out of this crisis, and I hope that government actually views this crisis in the same light of seriousness as what COVID has been viewed. In our next session, which will be the 13th of June, we are going to talk about something that affects every accountant, every auditor, every preparator of financial statements, but also anybody that is responsible for tax compliance. And that is just the disclosure of normal tax and deferred tax in the financial statements. We'll be focusing on IFRS on small and medium enterprises. How does deferred tax work? How does a proof of deferred tax work? Why is it important that we're able to do this? And how do we interpret the financial statements arising from them? I want to thank you so much for your attention. Please note that if you do need the CPT certificates, please drop an email to Natasha. She will send that out to you. If you do need the recordings, that will be distributed to you. Thank you again for your support. We really appreciate it. Have a lovely day, and we'll chat again on the 13th of June. Goodbye.